Hello and welcome back to another video of Curly's Trading Blueprint, the second half of liquidity. In this video we're going to go over some more draws in liquidity, but I'm actually going to start by breaking down and explaining the trade using liquidity and how we use our liquidity to take winning positions. When we go back to our chart right here, as you can see, we're accumulating. We're going to go over actually what accumulation, manipulation, distribution is later on in this video, but for now basically we're going sideways. We're going sideways right here. From what we know, we've left this kind of swing high right here. We would agree that's a swing high to the upside. We've also, when you look over here, left an unfilled fair value gap. As you can see, there are through two draws in liquidity we can target. But we also have these lows down here. They have obviously been swept. We have this low right here, which was the lowest point of the move down, which could be considered a swing low. And this is actually the previous day low. Not the previous day low, but the day low. We just put in the lowest point NASDAQ has been in that day. So this scenario you could expect a reversal of. But when I let price play out right here, as you can see, we come down to the downside and we end up taking out this low right here again. But we have SMT at our lows down here. So when I write that in, SMT here. So now we have a liquidity sweep right here, a money sweep to the downside. Then we have an SMT, as you can see right here. And what do we leave behind? This area here. So this is where the liquidity has been taken from the market. This low and sweep down here has been a liquidity sweep. Yes, we did, if anyone noticed, we did get this inversion right here back up. We didn't have SMT down here. We didn't inverse so much momentum. It's very choppy. It ends up going up and you would have been break even on this position. But for this example we're going to look at here, wait till you see how quick this moves. I'm introducing how we use the liquidity on one side of the chart to then target on the other side. So we would agree we have a liquidity sweep here. We have SMT. Obviously SMT and liquidity sweep go hand in hand. That means ES has not taken out this low from from previous videos. And we have this fair value gap to the upside. When I let price play out, when you see we're making super good bullish candles, basically no top wick, nice momentum to the upside. If you look at these candles here, no top wick, no top wick. Well, there is a little top wick, not no, sorry, but hardly any top wick compared to the body of the candle. It's looking super bullish to these highs here and this unfilled gap that we have marked, as we know there are draws on liquidity for us. When we also look, I talked about using order blocks as draws on liquidity or as areas to put stop loss. And when you look here, we have this order block right here. When I put that in, so we have an order block as well to the upside. Now, we've obviously taken out the liquidity here. We've the liquidity sweep, SMT. Where does price expect to go when it sweeps out a good area of liquidity and gets a nice V-shape inverse back to the upside? Draws on liquidity to the upside. From what we've gone over so far, you should know that. When we take out liquidity on one side and immediately flip and start heading towards draws higher, they are our draws on liquidity. Now, in this example here, we be entering when that candle closes, when we get that inverse. I'd be covering the order block. As I've talked about, you can use your order block as a place to cover stop losses. So there's an example of that. And then when we drag our TP level, we will be looking for this unfilled gap. But it's under 1 hour, as you can see right there. So the minimum I take on my trades is 1 RR. And when I move price up here, that is the minimum I'm willing to take on my trades. We're going to go over that later in videos on how in the rules I take to do and place in my trading. But as you can see, when you let price play out, that is an example of a winning trade. As you can see right there, we end up taking out our draws on liquidity. We don't end up hitting TP here and the price comes back down. That is okay. That is going to happen in your trading. Sometimes you're going to get break even when your draws on liquidity go, because after we sweep this high right here, as you can see, we get immediate reaction back to the downside. Now, luckily, we wouldn't have been taken out in this position break even, and price ended up going back up to the high and taking us out for a profit. But sometimes that is going to reverse off your draws on liquidity, especially if they're under 1 hour. But as I said, in my opinion, the best way to trade is take minimum 1 RR on all your positions. Now, we've just literally went through an example of it. And you didn't even know what you're doing, but we actually went through external to internal. And what do I mean by external? External is a lowest point or a area outside of our range. Remember, we went through our ranges on premium and discount. This is the bottom of the range. If I was looking for a pullback on the higher time frame, like if I went here and wanted a big pullback, this would be the bottom of the move right here. As you can see, I would have pulled it up as we went through in other videos, maybe to the top here, and then you could have looked for a pullback into a key area. Remember, we went through that in premium and discount. This is an example of external to internal. External liquidity will be like previous day's lows. Session lows can be external liquidity. When you look at a chart, it's the wicks not in the range, at the top or bottom of the range we went through on premium and discount. In this example, this previous day low we had that we create SMT with, or not previous day low, current day low that we had, that we end up sweeping out 3 times and then re-sweeping again the V shape, that is external. That is at the bottom of the range. When we end up taking out the external liquidity, then we can target the internal liquidity. A lot of times our internal liquidity is going to be swing highs or unfilled gaps. Make sure you remember that. Swing highs or lows, obviously. In this example, it's a swing high or unfilled gaps. As we marked out, we have our unfilled gap right here, and that is an area of external or internal liquidity. So that is external, internal, as you can see right here. Now we're going to get into an example of internal to external. Now, we went through external to internal, but let's flip it. Let's do internal to external. And internal, a lot of the times we'll be looking for taps into fair value gaps, sweeps inside gaps, SMTs inside the range, sweeps of liquidity inside the range to target the bottom of a range. In this example here, we get a pullback up here. Now, we've tapped into this fair value gap inside the range, internally in the range. As we're coming down, we pull back into the internal part of the range. We've a wick right here. What happens to that wick? Liquidity sweep. Yes, you know what it is. We end up getting an inverse to the downside right here, as you can see right there. Then, we also get this inverse right here to the downside, as you can see, pushing us to the downside right there with super good momentum, and also leaving this wick right here to the upside that, as you can see, tapped into this fair value gap. So we have, not only do we have a tap in a fair value gap, we have a sweep inside a fair value gap, we have 2 inversions to the downside. We also have this wick right here that respected this fair value gap, showing us we're going lower with a momentum candle to the downside. And that would have been my entry right there. I would have put my stops at this high here. It is, in my opinion, a protected high. What do I mean by protected high? It means I should not expect price to go back to that level as it's pushed us down. We have used that as like a wall. We bounced off it to go back down. That's how I like to describe these fair value gaps. It's like we're hitting a wall and we're bouncing off it with momentum. If you smash or hit a ball against a wall, if you're really close to the wall, it might shoot out quicker than you went and hit it with. Don't know the science behind it, but it just makes sense in my head. Pretend your fair value gaps are areas like a trampoline you can bounce out of. As you can see, we got that right there. Swept, got our inversion to the downside right here. We just didn't get the inverse with this candle here. We end up respecting it, just about closing just above it. So we needed to see more momentum to the downside for me to be happy taking this position. As you can see, we got it right there. From our trading so far, you know that this is a break-even level. This is an area we can go break-even at. So I'm going to mark out my break-even level, as you can see. And then we would enter our position right there. And as I've said, we don't have many draws on liquidity lower, as our draw on liquidity was under 1 hour. I'm showing you this on purpose, showing you these positions that are only 1 hour. Obviously, I could go show you 6, 7 hour trades and pick the best example. But I'm trying to be 100% real and honest about how this actual strategy works and how we like to trade. A lot of days our trades are between 1 to 2 hour. Once a week or once every 2 weeks or something like that. There's no guarantee on it's going to be once every 2 weeks. Just giving you a ballpark figure. You might get above 2 hour, 3, 4. I've got 6, 7, 8 hour on positions before from trailing my TP the whole way down. But I'm trying to be real and honest about the type of trades you're going to be taking with this strategy. And as you can see, that ends up coming down and we end up getting our 1 hour. And that's us done for the day again. A simple trade, everything's making sense. Everything makes sense where we're going. Draws on liquidity makes sense. We've tapped and we're respecting fair value gaps, liquidity sweeps in the internal range, inside the range. And then we get the inverse pushing us back down to the external part of the range right here, as you can see. go break even as it's only 0.35R, I'm still happy to take it because of everything else I'm seeing up here. I'm definitely expecting this low to go, and as you can see, price ends up playing out and we end up hitting TP on this position. And that is exactly how I trade internal to external liquidity. Now, the next type of trade I want to go over, and the last one we're going to do for this video, is AMDs. We've obviously went over external to internal, internal to external. Let's go over AMD. What does it stand for? Accumulation, manipulation, distribution. What does that mean? Accumulation is basically where price can't break one side or either side of a range. Let's look at this example right here. From this chart, as you can see right here, from what we went over, I would say this is the top of the range. From the area we're in, this is the top of the range. It's also London high. So that is London high. What is London high to us? A strong draw on liquidity. So we can look to target that maybe for a trade or look for a reversal trade off it. When we look at this chart again, I would also say we have a swing high right here in our chart, on our chart inside the range, as you can see right there. We have a swing high. In my opinion, we've tapped this fair value gap. We put in this high and went lower. When we also look, I would say we have a swing low here because this sent us higher with price. This is another draw on liquidity for us to the downside. And as you can see, between this high here, and this low here, we have not been able to break the range. We're stuck in this kind of box range right here, as you can see. We can't go anywhere. When I actually put my box, I would mark this as the accumulation. Price can't break this range. It needs to take out one side of the range or either side for us to even look for a position. So that is accumulation. It's where price is not going anywhere. It's going sideways. It's like barcodey, we call it in our trading. It's barcode price action, and we can't get a move to the upside or downside. If we're looking to take a position from what we've went through, we'd be looking for one side to get swept and then maybe target the other side if we draws on liquidity to that side of the range. Let's say we took out the London high, got reversal straight away. Maybe if there's SMT, if there's other things as well, we could look for a trade at this low, and the same thing going the other way back to London high. When we let price play out from the accumulation, as you can see, we end up getting this push to the downside. What do we get? A sweep on liquidity. This is our distribution. So let's mark that out. We're also going to mark this in a different color box. We'll go with green. So we have this distribution to the downside right here. As you can see, price has left the accumulation area, manipulated lower. So manipulation is where we manipulate a low, go under a low, take the liquidity and reverse from that area. That is the manipulation. Because when we go under this low, some people might then be looking to take short positions down the trades down here. But we're manipulating them out of the market by taking this low with this liquidity sweep. And then we be looking, in this example, for distribution back to the upside to the London high up here. We'll mark that as a pink box. There you go. We're looking for the distribution back to the upside towards this high. And when I let price play out, as you can see, that is exactly what happens. So if you want to take a screenshot right here of the accumulation, manipulation, distribution in the boxes before I clear them, I would put that in a journal, mark that as that is a key, and that's quite a clear and obvious manipulate or AMD setup. Accumulation here, manipulate lower and distribute higher. When I take the boxes off my screen and break it down, because we obviously know we need an inversion to enter. Have we got an inversion in our trade? Let's go back here. Let's mark out what we're seeing in our trade. So we have this liquidity sweep here. We would agree, yes. Then we end up at, remember I said, when we take out a key low like a liquidity sweep and then close when engulfing candle, what do we form? An order block. Yes, you guessed it. Hopefully you guessed that right. I don't know if you did, but hopefully you did. Or else I thought it didn't teach you well. That is an order block right here. So price has showed me we're maybe pushing back to the upside. We'll need to inverse this gap to show me that we're still going to the upside. And when obviously from what you've seen before, when we let price play out, we get a beautiful momentum candle back to the upside right here, as you can see. That would be my entry right there. Because we've drawn liquidity higher, because we've accumulated, manipulated, or start to distribute, with the inversion with momentum, I put my stop loss under the order block right there. Move this out of the way. And then from what we've went through, we would be targeting the London high. Obviously, that would be our draw on liquidity. You might get a bit higher depending on how quick it shoots through the high, so on and so forth. What would this be for us? This would be our break-even level because it's a swing high, a draw on liquidity for us, and because it is under the 1 hour level, that is the area we can't take profits at that. So that is a place price could reverse from. A swing high is an area price could reverse from. So that is where I will go break even on this position. And as you can see, price ends up pushing up. I think you would have been took out by this wick coming down here because the way we like to trade with our trailing TP rules. We'll go over that later when we're starting to actually take positions. And that is very simply the trade we can use to accumulate, manipulate, and then catch the distribution higher in this example. Make sure you take a screenshot right now of that trade right there and get that into a journal. That is a perfect example of accumulation, manipulation, distribution in my example. Price can't move. It's sideways in the range. Like we're accumulating inside a range. We can't break the highs and low. The liquidity to the upside and downside. We've draws on both sides of the range and we can't take either one out. So we need a way for one to go and then we can look for price to reverse off it and target the other one. And that's exactly what we get here. Get the push to the upside and as you can see it would have smacked TP and we obviously as we went through have a key draw on liquidity here and London high as our TP level. And that is the exact trade I took on this day and I made just about 1.2 R on this day. As I've said, I'm showing you lower RR trades, trying to give you the reality of the situation of how we like to trade. But when we distribute, you can expect price to push higher. And in this example, we obviously take our draws and liquidity. But if you held, price end up still going higher in this example. So you maybe could have got more depending on the day. I would have definitely been took out somewhere in this leg up or took out somewhere trailing over here at the latest. That's what I would recommend taking your levels at or even taking your TP at London high because it's the draw and liquidity. As I've said, you're just trying to get a little bit extra with your trailing TP. Don't get greedy. The minute this goes, make sure you trail the 1 hour. So I would have put my stop loss there. Price kept pushing up, so I would have dragged with it and I would have been took out there as I showed, as what happened on this exact day I took this trade. That is very simply AMD. Can't break it down much clearer. Make sure you go back, look at the boxes I drew. Make sure you understand the AMD, the accumulation, manipulation, lower in this example or higher if it's an example to the downside. And then the distribution lower or higher depending on where the manipulation went. We're obviously looking to target the other side of the range with the distribution. Make sure before the next video you find 5 examples of accumulation, manipulation, distribution, 5 examples of that trade, and then 5 examples of internal to external, external to internal, and that's what I will go over before the next video to make sure you really understand them before we move on our trading. We are going to get into starting to actually look at positions and take trades. But in this video, we've already went over 3 trades you could look at. I literally did 3 trade recaps as well explaining why we're taking it with the internal, external and AMD. So make sure you journal them trades in a journal. You can use some free apps like Notion. There's loads of other ones to go over. You can put them into your journal, these trades, and make sure you write out why I took them. Why, in my opinion, as I've said, they were a good trade. Just so you have them to look back on. When you're finding trades and examples on your own chart, you can use them as a base point to go off for taking and looking for your own positions. And that is what I would do before the next episode. There's a lot to do there and a lot to go over, and I did put a lot at you in this video, but make sure you really understand the internal, external, external, internal, and AMD, as they're a key part and in all our trading setups. We're always targeting or taking one example of them trades. That is going to be it for this video. Make sure you do everything I told you to do before the next video, and I'll see you on the next episode of Curly's Trading Blueprint. Peace out.